Currency T here. What you're about to see is the clearest example of the paper versus physical conflict I've documented in 18 months. Silver dropped 8.7% in 72 hours. Gold fell from 2,957 to 2,881. Standard panic, right? Except COMEX registered vaults lost another 4.2 million ounces during the same window. Physical premiums spiked to 47% over spot. Dealer inventories hit 11-year lows. The paper market is telling you to sell. The physical market is telling you the exact opposite. One of these is lying. Let's find out which one. Stay with me. Let's get to the hard data because this is where the story gets interesting. Silver spot closed Friday at $35.20. By Monday afternoon, we hit $32.14. That's 3.06 down, 8.7% move. Gold went from $2,957 Thursday to $2,081 by Monday close. That's 76.6 or 2.57%. Now here's what happened simultaneously at COMEX. Registered silver inventory, the stuff available for delivery, dropped from 38.7 million ounces to 34.5 million ounces. That's 4.2 million ounces withdrawn in 3 days during a price crash. Think about that. Price falls, and physical drains faster. I pulled the warehouse reports. JP Morgan's vault lost 1.8 million ounces. Brink's lost 1.1 million. Delaware lost 940,000. This isn't small money moving around. This is institutional-scale physical withdrawal while paper contracts get hammered. Meanwhile, I'm seeing premium data from dealers. SD Bullion, JM Bullion, AppMex, all showing American Silver Eagles at $7.50 to $9.20 over spot. That's 23% to 28% premiums. Generic rounds at $4.80 to $6.10 over. That's 15% to 19%. Weighted average across products, 47% premium environment when you factor in availability constraints and delayed shipping. Gold? Same story, different scale. American Gold Eagles at $135 to $158 over spot. That's 4.6% to 5.4% on a $2,881 gold price. Premiums expanded while price dropped. This is not normal selling. This is something else. Now connect the dots because nothing moves in isolation. The dollar index, DXY, spiked from 106.2 on Friday to 107.8 by Monday. That's a 1.5% surge in 3 days. Strong dollar, weak metals. That's the textbook trade, and that's what paper traders sold. But look at the 10-year Treasury yield. Thursday, we were at 4.51%. By Monday, 4.68%. That's 17 basis points in 72 hours. Yields up, dollar up, metals down. Classic risk-off rotation. Bitcoin confirmed it, dumped from $101,800 Thursday night to $94,300 Monday morning. That's a $7,500 drop, 7.4%. Risk assets got sold across the board. So the narrative is clean. Dollar strength plus rate fears equals metals liquidation. That's what happened on paper. But here's the intermarket conflict I'm watching. Gold-silver ratio spiked from 83.4 to 89.7 in 3 days. That's silver underperforming gold by a massive margin. When silver gets hit 8.7% and gold only drops 2.57%, that ratio explodes. Historically, when that ratio spikes above 88 during a physical shortage environment, you're not seeing fundamental selling. You're seeing either forced liquidation or paper manipulation into a physical bottleneck. I pulled the COT data from Tuesday. Managed Money, the big specs, added 8,200 short contracts in silver during the sell-off. They didn't cover. They added. That's position building on the way down, not panic. Meanwhile, the Commitment of Traders report shows commercial hedgers reduced their short position by 3,400 contracts. Commercials, the producers and big banks, covering shorts during a price drop? That's a reversal signal. Cross-reference that with the gold COT. Managed Money added 6,700 longs in gold while cutting 2,100 shorts. Net positioning went more bullish during a $76 price drop. So paper positioning is saying this is a bottom, but paper price is saying this is a breakdown. The conflict is blatant. Now add in the Bitcoin correlation. Normally, Bitcoin and silver move together about 68% of the time over 90-day windows. But during this dump, Bitcoin fell 7.4%, silver fell 8.7%, but silver premiums expanded while Bitcoin premiums on exchanges collapsed. That divergence tells you digital risk assets are being sold for liquidity. Physical metals are being bought for safety, but the paper price hasn't caught up to the physical demand signal yet. Last piece, the M2 money supply data updated last week. M2 contracted 0.3% month over month, but the 3-month trend shows expansion resuming at 1.8% annualized. Liquidity is coming back into the system, but we're in the lag phase where the dollar spikes first, then liquidity shows up 6 to 8 weeks later. If that's the cycle we're in, metals get hit now, then rip later when M2 expansion confirms. Here's your fork in the road. I'm giving you both scenarios with exact levels because the data supports both until one breaks. Scenario 1. The bull case. Capitulation, low into reversal silver just tested 32-hour torn-tours. If that holds as the low, here's the path. First resistance, $33.80. That's the 20-day moving average and the breakdown retest level. Silver needs to reclaim that within the next 5 trading days to confirm we bottomed. Second resistance, $35.20, the prior high. That's your confirmation that the sell-off was a shakeout. If we reclaim $35.20 within 2 weeks, the bull trend is intact. Third target, $37.60. That's the 1.618 Fibonacci extension from the October 29.80 low to the January 35.20 high. If silver clears $35.20, $37.60 is the measured move within 30 days. Ultimate target in this scenario, $42.10 by late March if the physical shortage accelerates and COMEX registered inventory falls below 30 million ounces. Gold scenario 1. Low is in at 2,181. First resistance 2,120. Second resistance 2,057 retest. If gold clears 2,157, we target 3,025s within 3 weeks. Ultimate bull case, $3,180 by April if dollar index falls back below 105. The bull case requires DXY to fail at 108 and reverse to 106. Bitcoin to reclaim $98,000, confirming risk on, and 10-year yield to fall back to 4.50%, easing rate pressure. The physical market conflict supports this scenario. If vaults keep draining and premiums stay above 40%, paper price has to converge to physical reality. That convergence is explosive when it happens. Scenario 2. The bear case. Breakdown into deeper correction. Silver loses 32.14 and tests $30.80. That's the next major support from November. If 32.14 fails, 30.80 is the demand zone. If 30.80 breaks, we go to 28.60. That's the 200-day moving average and the October breakout level. Breaking 28.60 would negate the entire Q4 rally and put us into a 6-9-month correction. Gold bear case. Lose $2,181, test $2,120. That's the 50-day moving average. Break 2,020, we're going to 2,640, the November consolidation floor. That would be a full retest of the pre-election breakout. This scenario requires dollar index to break above 108 and run to 110. Bitcoin to lose $92,000 and test $85,000, and yields to spike to 4.85%, forcing more deleveraging. The catalyst for the bear case would be forced liquidation from pension funds or sovereign wealth funds needing dollar liquidity. We saw hints of this last week with $1.8 trillion in reported pension rebalancing flows. If institutions are forced to sell metals to cover margin calls in other assets, paper price can go lower even if physical demand stays strong. That dislocation can last 3 to 6 weeks before it resolves. Here's the key. Even in the bear scenario, the physical shortage doesn't go away. It just means paper price overshoots to the downside and the snapback is more violent when it comes. So your trade depends on your time frame. If you're a trader, you need to watch 32.14 in silver and $281 in gold like a hawk. Below those levels, hedging or taking profit makes sense. If you're an accumulator and you believe the physical story, this is a gift. You're buying silver at $32 with 47% premiums, meaning the real all-in cost for most people is $47 per ounce. When paper price catches up to physical, you're buying at a 32% discount to reality. So what do you watch in the next 24 to 48 hours? Number 1, COMEX inventory reports. If registered silver falls below 34 million ounces this week, the physical shortage thesis accelerates. If it stabilizes or rises, the selling was noise and we're consolidating before the next leg up. Check the daily COMEX reports. I'll be watching JP Morgan and Brinks specifically. Those two vaults control 60% of registered inventory. Number 2, dollar index at 108. DXY hit 107.8. The next resistance is 108.2, the September 2024 high. If dollar breaks 108.2, we're likely going to 110, and that pressures metals further. But if DXY fails at 108 and reverses, metals rip. A rejection at 108 would be a massive bull signal. Watch that level. It's the pivot for the whole trade. Number 3, Bitcoin support at $92,000. Bitcoin is the risk-on canary. If BTC holds $92,000 and bounces back above $98,000, risk appetite is returning. That's bullish for silver. If Bitcoin loses $92,000 and tests $85,000, we're in deeper deleveraging. That's bearish for paper metals, but ironically bullish for physical as a safe haven. Number 4, dealer premiums. If premiums stay above 40% this week, the physical shortage is real. If premiums compress back to 20-25%, the supply crunch is easing. I'm checking SD Bullion, APMEX, JM Bullion daily. Shipping delays are also a signal. Right now, I'm seeing 7 to 10-day delays on generic silver. If that extends to 14+ days, supply is tightening further. Number 5, the 10-year yield at 4.70%. If yields break above 4.70%, the bond market is rejecting Fed dovishness. That's bearish for metals short-term because it strengthens the dollar and raises opportunity cost. If yields fall back below 4.60%, rate fears are easing and metals can catch a bid. That's 4.70%. Market. Bonus watch. China physical demand data. Shanghai Gold Exchange premiums have been running $15 to $25 over London spot. If that premium expands above $30, Chinese buyers are loading up. That's a leading indicator for global demand. Also, watch the yuan. If the PBOC devalues further, Chinese buyers rush into gold as a hedge. We saw this in 2015-2016. It could be setting up again. Your action plan, if you're long and want to stay long, your stop is $32.14 silver and $2,181 gold. Below those, step aside. If you're in cash and waiting, you're looking to buy a bounce above $33.80 in silver or $2,920 in gold with confirmation. If you're an accumulator, you're buying physical now, ignoring paper price and focusing on ounces. There's no wrong answer. There's only know your thesis, know your levels, and execute when the data confirms. Zoom out for a second. The big picture is this. We're in a global monetary reset. Central banks bought 1,037 metric tons of gold in 2023. They bought another 1,045 metric tons in 2024. That's 2,082 tons in 2 years. Record pace. Why? Because the dollar's weaponization is forcing sovereign diversification. Russia, China, India, Turkey, all loading gold. Not because they think gold is going up, because they think the dollar system is fragmenting. Silver is the derivative play. Industrial demand from solar, EVs, and 5G is running 1.1 billion ounces per year. Mine supply is 850 million ounces. The deficit is structural. COMEX has 34.5 million ounces registered. Global investment demand is running 250 million ounces per year. COMEX registered is 13.8% of annual investment demand. If just 5% of that investment demand tries to take physical delivery, COMEX runs dry in under 2 months. That's the setup. The paper sell-off we just saw, it's either the final shakeout before the shortage goes mainstream, or it's the beginning of a deeper correction that gives you 6, 10, or 9 months to accumulate before the real move. Either way, the macro thesis hasn't changed. Debt is $36 trillion. Deficits are running $2 trillion per year. M2 is expanding again. The Fed can't tighten without breaking something. That something broke in regional banks in 2023. It'll break again, and when it does, metals are the only asset without counterparty risk. So here's what I want from you. Drop currency T in the comments so I know you're tracking this. Tell me, are you buying this dip or are you waiting for confirmation? And if you haven't subscribed, do it now. This channel is anti-hype, data-only analysis. No sales pitch, no affiliate links, just the hard truth about what's happening in precious metals and macro markets. Hit the bell. You'll get these updates in real time when the data shifts. This is the moment where the paper and physical markets diverge completely. One of them is going to be proven right in the next 30 days. My bet? Physical wins. It always does. The question is, how much pain paper price has to inflict before it catches up? Stay sharp, trust the data. Don't trade on emotion. This is T for Currency T. Out.